Welcome everyone. I will just get my guests onto the stage. One moment. Hi. There we go. How are you? Cool. So I'll start right off. We have got a great webinar talking about credit and lending and all the changes that are happening at the moment. I'm Stacey. I'll be the host. I am the sales and marketing coordinator at Relab. On stage with me is Night Howe, CEO and co-founder of Relab, and we've got John or JB from Squirrel. So JB, just to introduce you a little bit. You are a former general manager at ANZ and started Squirrel in 2008 during the GFC. Can you tell us a bit more about your background and what Squirrel does?
Yeah, sure. So so I was a general manager of products for ANZ. I've 12 years in banking. Squirrel set up 2008, so it's a while ago now. Coming up 14 years. So Squirrel is probably certainly the largest mortgage broker in Auckland. We write a little over $2 billion a year, or around $2 billion a year. We also have our own funding lines. So we have a peer-to-peer lending platform. We also access some wholesale funding lines. We've just launched a managed fund a couple of days ago, all orientated around helping us fund small-scale pre-development land banks and other bits and pieces. But obviously, in addition to that, we do a lot of funding in the non-bank space, mostly in the development space, mostly sort of tourist housing. That's probably a bit of a sweet spot for us. And obviously a huge amount of first home buyers, which is the other side of these transactions. It's the people actually buying your product. So that's us.
Yeah. Obviously, there's a lot going on in terms of changes from the government, etc. And I noticed in the media and the news it's quite negative, gloom. The world's coming to an end, sort of with housing and all of that. What are the changes going on, and what do you see firsthand? Because sometimes reality is quite different to what's shown.
Yeah. Look, I can follow up. Poor Knight won't be able to ask any questions because they'll probably take half an hour to answer. Look, I guess, everyone knows inflation's popping up as a bit of an issue globally. It's not surprising given the amount of money printing that's been going on, both fiscally and then in terms of loose monetary policy and low interest rates globally, right? So it's not just a unique thing to New Zealand. I guess what's unique here is that our Reserve Bank's been one of the first to start increasing interest rates ahead of the curve, which is a good thing. It just means we've got a good Reserve Bank. And people argue they're a bit slow. They're certainly faster than everyone else. Aussie at the moment, if you're following Australia, they've got a runaway housing market over there as well. And the Aussies seem to be crazier than Kiwis, right? So at least we're not as crazy as them. So look, that backdrop, interest rates are clearly going up. I think my view is they've peaked, they've overshot, and this typically happens at this point of the cycle. When interest rates start to go up, they initially go up really, really fast. And what's driving that is consumer panic. So you imagine you've got billions and billions and billions of dollars of home loan customers rushing into fix. That actually just pushes up wholesale rates because the markets can't clear it. And so the wholesale markets are overpriced. So, you've got 1 year fixed rates at the moment, a little below 4, between 3.6 and sort of 3.8%. The reality is that if you project 40 year and a half, I don't expect to see the 1 year rate much higher than that, maybe low 4s. So I think the fixed rates have largely run their course. And they're already pricing in significant OCR moves next year. So, whilst everyone's saying, OCR is going to go up next year, absolutely. But it's already priced into those fixed rates. So I think those fixed rates are starting to reflect, a bit more in terms of what will happen longer term. And look, at least my view is I think you'll see housing rates settle down sort of in the mid 4s. And I think that's pretty much as high as it will go. Of course, there'll be people out there that think rates will go a lot higher. There'll be people out there that will think they'll drop. right? I think the economy is not nearly as strong as everyone's making it out to be. I think that, sure, there's some consumer confidence out there at the moment, and there's certainly inflation out there and low unemployment. But what's going to be really interesting is to see the impact of higher interest rates and less fiscal stimulus and less monetary stimulus, right? So, if you think about the increase in the interest rates, which is, probably getting close to 2% now. 2% on 330 billion is like taking $7 billion out of the economy. It's a serious amount of money that they're pulling out. So we haven't seen the impact of that yet. And the way I like to translate that through to anyone really is just to say, well, okay, take your sort of average first home buyer in Auckland at the moment is probably buying some property for close to $1 million. Borrowing sort of 850,000, right? 2% increase in interest rates is going to take about 12,000 a year or $1,000 a month out of their back pocket. Go find me a first home buyer that's got $1,000 spare each month floating around. It doesn't exist, right? So what's going to happen is they're going to have Kiwis are going to have to adjust their budgets. They're going to have to adjust their spending behaviours. And look, this has happened forever. It happens in every cycle. So what happens is they spend less, right? It's going to be less on holidays, less on luxury items, less on hospitality, less on domestic tourism. So, when you think about COVID and you think about coming out of lockdowns, and particularly the hospitality trade, desperately wanting to fill restaurants and everything else, I think you're going to find with this bounce out of this lockdown, it's not going to be nearly as strong as the last one. The consumer spending is just not going to be there. And people are going to be starting to bunker down because of the higher interest rates. So, people, as interest rates go up, people are going to have less discretionary spending. They're going to be spending less in the restaurants. They're going to be spending less on travel, less on luxury items. We're starting to see that coming through. So I saw a survey result, I think it was an ANZ survey result last week that said confidence in buying big whiteware or big good has dropped significantly. I think it's the lowest it's been for a while. So you're sort of starting to see higher interest rates translating into the way that consumers are thinking. So, that translates into weaker economic activity. So there's a lot of good things going on in the country as well. And we could point to lots of positives, export sector, agriculture, everything else, high commodity prices. There's lots of good news out there as well. But, my sense for it is that the economy is going to be weaker than I think most people are predicting next year. People like Stephen Topless at BNZ have come out and said they're expecting house price falls. And I think we've seen a few economists coming out saying that now. It's always a brave call for an economist to call a reduction in house prices. But I think what they're pointing to is fundamentally correct. So I think there's a couple of things that are going on. One is that do not underestimate the impact that higher interest rates has on people's willingness and ability to borrow. It's really significant. And these house prices were really at the upper end of affordability. So anything that's dragging away from that is gonna impact on people's ability to buy. The second thing is I think we will end up with a bit of oversupply. So I think the Reserve Bank's pointing to that, and I think you've got a couple other banks pointing to it now as well. And I know that when we've had such a shortage of property for so long, it's hard to wrap your head around that. We might have a surplus of property, but I think there's a distinct possibility that we'll be facing that in the second half of next year. And look, that will be through lower demand and less people able to buy, as well as potentially a bit of an oversupply in some parts of the market, not all parts of the market. So I think that's what's driving that. Look, anyone's guess, but you can certainly tell a story that kind of lands with a softer market in the second half of next year. So, but like with anything, the market keeps ticking over. Yes, there'll be lower sales volumes. Yes, you might get a little bit of reduction in prices in some parts of the market, but we've all been there before. It's kind of business as usual. I think the biggest risk from a development perspective is people paying way too much for land. We've seen crazy prices paid in the Auckland market in the last 6 months because developers and builders have just been so desperate to get supply. I think in this part of the cycle that gets quite risky because there's nothing worse than holding overpriced land in a falling market. The reality is, and all the guys on the call will know this, as a developer or builder, you can't sit on stuff. You need to keep turning it over. So that's always the risk. You can't wait for prices to come back. You pretty much got to keep going. So I think you're going to see some margin contraction. You're seeing that certainly seeing that in the papers. I'm seeing deals where people are just doing them for too low returns. A year ago, everyone's like, right, minimum return on my project, 20%. But I've seen some deals going through recently where people are doing them at 14 or 15, and it's not really leaving you a lot of margin if things go wrong. Probably, if we've got developers on the call, they know their business. What I can do is talk to what I'm seeing from a buyer perspective and also from a funding perspective on development stuff. So maybe we start with buyers first, because of course that's the demand side of the equation. So on the demand side, obviously the LVR restrictions are in place. That doesn't impact new build, so new build's exempt from that. So that's kind of fine, right? It's actually probably good for developers, and that's pushing more and more buyers into new build, arguably, including investors, right? While we talk about that, investors buying into a softer housing market, new build, not so sure. I don't think you're going to see a lot of confidence there. As far as first home buyers are concerned, it's not so much the LVR restrictions that you should be worried about, it's the changes to CCCFA. So we're already in the first couple of weeks, these rule changes effectively don't go live until the 2nd or 3rd of December, but we're already seeing the impact because banks have already started adjusting policy to this. So the
Right, for our audience who doesn't know the acronym CCCFA, do you mind just outlining to them what it is and what it means?
Yeah, totally. So CCCFA is the Consumer Credit Contracts and Financing Act. So basically it's a piece of legislation designed to protect vulnerable borrowers from predatory lenders. So typically high cost payday lenders, high cost finance companies and stuff. But in the retail world, it covers all lending. So it covers that sort of lending, but it also covers credit cards and it covers mortgages. So effectively anyone lending to retail customers over owner-occupied property where it is for personal use, so it ignores business use, for personal use, CCCFA legislation applies. Now, the problem with CCCFA legislation has good intentions, right? It's designed to protect consumers from predatory lenders. But of course, everyone has to live by it. Now, the problem with the response with the CCCFA is that it's also tied into another piece of regulation called the Responsible Lending Code. And the Responsible Lending Code says that you shouldn't lend to vulnerable borrowers, that you should make sure that you're dotting your I's and crossing your T's and checking everything before you doing an approval. And so it's really prescriptive in terms of saying you've really got to understand your customer in a lot of detail before you give them finance. And you'd say, okay, well, that's probably okay. And you can sort of see how this legislation gets enacted because everyone goes, well, that sounds sensible. But what it doesn't do is it effectively turns your bankers into people that have to make judgment. And, having your banker make judgments on you is generally not a great idea, right? And the computer says no, they don't have the flexibility to then kind of think outside the square because they're too nervous to, because the regulations are pretty strict. So look, this CCCFA stuff, the change that's coming in is really putting a lot of pressure on the banks to make sure that they check everything, they iron out all the details, they verify everything about a borrower's life. They think about the borrower's future, and it's not just what they look like now. They've got to project forward 12 months and sort of try and anticipate any changes in their life. So it's pretty thorough. Now, the thing is that with buyers, we're testing their ability to service a loan, often at higher interest rates a reality, right? So most loans at the moment are tested at 6.5%. So much higher interest rate than we'll even get to, right? Because rates will probably peak around 4.5, yet we're testing at 6.5. So you could argue there's already fat in the system with the way that banks assess these loans, but now they're really strict on expenses, and so they're literally going through bank statements line by line, making sure every expense has been captured. Now the problem is that most Kiwis just live within their means. If there's $1,000 in their bank account, they spend $1,000. So typically we can't demonstrate savings. And when we go to put the expenses in, we've got to put the full expenses in, and so we can't demonstrate affordability. So this is a really big issue, and it's going to significantly reduce the borrowing power of most first home buyers. Can we coach them to do it better? Yes, we can. We can coach them to not spend so much money and save better. But notwithstanding that, it's going to cause us some issues. The other side of it is that whereas in the past we might have got away with maybe expenses that were a little bit on the light side, but we felt comfortable with it because we knew that they could save money if they needed to. Now there's a lot more sort of strictness around this. So basically it's black and white, and a lot of the grey's been removed. And in removing the grey, it's just reduced the flexibility to solve problems. So what we're already seeing is people that have purchased off plan that no longer pass credit criteria. So as developers who have sold down developments, one of the things that you're going to start running into is borrowers that can't settle. And I think there is a distinct risk at the moment, and I think that risk has gone up significantly. So we're already seeing it. So this week, I think I've seen 2 already. Personally, these are deals coming into me with borrowers that can't settle. So, this is going to be a growing problem. The other side of it is going to be borrowing power for people buying off plan, in the sense that whereas previously they might have been able to borrow 800, they might now only be able to borrow sort of 750. 750. So I think you're going to see a drop in borrowing power. Now that drop in borrowing power is getting compounded by 2 things. It's getting compounded by higher servicing rates, driven by the increase in interest rates, and it's also been impacted by these CCCFA changes, effectively reducing the discretion that banks are applying, tightening up, particularly around expenses, and therefore reducing borrowing power there as well. So for some borrowers, they're going to experience a fairly significant reduction in the amount that they can borrow. So as developers and builders, you're fronting into this because this is the market that's buying off you. So that's the buyer side. Look, it's not going to go away. The reality is that, we know in large parts of this market, the only thing that first home buyers can buy these days is terrace housing. That is the new standard for entry-level property in the New Zealand market, right? So that's not going away, and we're going to need tons and tons of terrace housing for forever, right? I always say to people, just go to Sydney or Melbourne or any bigger city, and it's entirely terraced housing. The same will be true here. In Takapuna at the moment, where I live, it's amazing how many terraced housing projects are going up around my place. I could probably count at least 10 projects on my night walk. And I don't walk very far. I'm lazy. But there's a ton of them going up all over the place at the moment. And all of you guys will be experiencing that in terms of what you're seeing around all of the cities. Even Wellington, what's going on in Upper Hutt at the moment. There's just a ton of stuff going on up there because there's just a bit more land supply. So anyway, digress. Maybe I'll take a breath. Night. Any questions that you wanted to fire at me so far?
I'll check with Stacey first, but that was brilliant. Thank you.
Cool. Okay. I might just go to flip to the other side because there's a couple of things that I think are really important for everyone right now. So funding. So development funding. So look, I think everyone needs to be a little bit careful in this space at the moment. I could talk for half an hour on this. So right here, right now, none of the finance companies have any money. So we are running into a lot of developers in the last week or two who are desperate to settle on properties who don't have funding. And I think they're used to just turning up to their finance company and the finance company going, cool, here's the money, off you go. and they've been surprised, somewhat surprised to go, oh fuck, I can't get the money. This is reality at the moment. So what's happened is that because of all of the slowdown of materials and delays in projects, and like Auckland's an absolute mess at the moment, just in terms of council consenting, getting your code of compliance and stuff, everything is just really slow, let alone the material issues. Is that the project delays mean that finance companies aren't getting out of their projects as quickly as they thought they would. And so, they're not getting release of funding nearly as quickly as they thought they would. And so they just don't have any new funding available. So it's kind of the perfect storm is that basically because projects aren't finishing on time, funders have run out of money. And there's honestly hardly any money out there at the moment. We're having to ring around everyone, just scraping the barrel, trying to find funding for people. Now, of course, banks have plenty of funding. So this is only an issue in the non-bank space. If you're funding projects through banks, it's business as usual. But the non-bank space is absolutely full at the moment. So now it's only a temporary issue. I think we'll see a lot of these projects, complete over the next couple of months. Some of these finance companies have got new funding lines that they've got coming on stream next year. So I think by February or March, we should be back to normal with funding. But for anyone that's looking for funding in the next 2 or 3 months, it's going to be pretty tough. And the pricing on it has gone up a lot as well. So I just got priced a deal just before this call, actually. And this isn't for development funding. This was simply for a pre-acquisition land hold, and the rate was 9% with 3% fees. So, which is high. I mean, we would have been funding that at a lot lower costs a couple of months ago. So, so just be aware of that. Development funding at the moment really tight if you're in that non-bank space. It will free up around February, March. It's temporary, just because of all the construction delays. The other side of it is I think you're starting to see a bit more conservatism creeping into banks and finance companies. Both sides are a bit nervous about this market. So they can see all of the things that I've already talked about. There's a credit crunch going on for buyers. Ironically, this isn't a global credit crunch. This isn't like the GFC. This is a government-imposed credit crunch due to what I would say is bad policy in terms of the CCCFA changes, as well as, obviously higher interest rates and then the Reserve Bank putting LVR restrictions back in place. So it's kind of government induced. The good news with government induced is that they can soften that up if they've tightened too much, right? So one of the things that I'm kind of expecting to see is that the Reserve, no one can predict what the Reserve Bank does, but my feel for it is that I think they're going to get a bit surprised how much they've closed the market down. And I wouldn't be surprised in sort of about March if we don't see them loosening up the LVR restrictions again. CCCFA, government can't really unwind that easily. We're just going to have to live with that mess for a while. I don't see that getting changed at all. So that's our new reality, and obviously interest rates are higher, and that's a new reality as well. But look, banks can see all of that. They are obviously forecasting a small reduction in house prices next year, so they'll be getting nervous about that. They do expect to see a softer housing market. They're nervous, obviously, about high supply side costs and all of the issues around delays and stuff. So I think you're generally going to experience banks are going to be more conservative. They're going to be harder to get money out of. Finance companies, look, we were doing some deals 100% funding in terms of loan to cost. We were doing that probably 4 or 5 months ago. That's been gradually disappearing from market. I think the best that we're probably doing at the moment is 90% of cost. And that's probably, in all honesty, is quite hard to do. That's with 100% pre-sales. It's just going to gradually tighten. And because, there is a shortage of funding there at the moment, everyone's being really fussy about what they'll do. So a lot of the guys I'm talking to at the moment won't touch land. They just won't touch it. A lot of them aren't even doing development funding at the moment, certainly outside of the major metros, and not without pre-sales. So just be aware that, we are in a weird kind of credit tightening part of the market that can't really be explained by external factors, maybe other than the fact that the construction sector's generally struggling with supply side issues.
That funding side of it's really interesting. I came across a development out in East Auckland that was they were selling the land and all the plans, the resource consent was done, and they were clearly couldn't must not have been able to fund it because they were just selling the whole package.
Look, I think you'll get some guys just do that because they've got too many projects on the go and they just want to. And like I know some guys that are selling down consented developments, not because they can't get funding, but because of the delays. They don't want to have too many projects on the go at once.
Yeah.
Because what's happened is they thought they would be staggered with their projects, but because the delays have been so bad, they're ending up with too many projects at once. And so they're like, wow, I don't really want to do that. So they're just selling off one or two of them. And the reality is I think there's still buyers out there for fully consented projects. So that's certainly feedback that I'm getting is it's actually not that hard to sell a consented project at the moment because there's a lot of guys out there that don't want to spend, they want ready to go projects. So they don't want to spend an exorbitant amount of time trying to get consent.
Yeah. And what is happening in terms of investors, like mum and dad investors? What's happening in that area?
Look, I mean, I think you've got a part of the industry that loves to go sell property to mum and dad investors. I affectionately refer to them as spruikiers. That could be either these property investment companies, quasi real estate firms, and or some accountants and various other businesses that, clip the ticket, take sales commission and sell investment property down to mum and dad investors. You can always line up people to buy property. I think that market will continue. I mean, it's been around with us for a long time. And, I think good salespeople can convince anyone to buy anything. Whether or not it's a good decision is an entirely different debate, right? So I think, look, a lot of property investors, I think the thing with particularly mum and dad property investors, they're very responsive to confidence. So, at the moment, when you start getting banks talking about falling house prices, that's the sort of thing that will shut that market down really quickly. The thing about buying off plan is that everyone can tell that wonderful story about how I put down a 5% deposit and then I didn't even have to settle the property. I sold it before I even had to settle it, and I made $200,000. $5,000, 5% deposit investment, and I make $200,000. It's just an amazing way of making money. We saw this post GFC. We saw a lot of people getting sold into apartments who struggled to settle after the GFC because they've been sold apartments on the basis that they couldn't lose money. And we had agents actually selling a whole lot of property to people where they go put these 5% deposits down on a whole heap of properties. No expectation that they'd ever have to settle them because property always goes up and they'll make a heap of money. And then the GFC hit and a lot of people got seriously burnt, right? Now, I'm not suggesting for a moment we're having another GFC because, as I said, this isn't a global problem. This is domestic government policy. But look, the reality is that, if we do front into softer house prices and, we can debate that, everyone will have a different view on that. But if we do, or put it this way, if people perceive that we're going to have softer house prices, if they believe it, then they won't buy, right? No one catches a falling knife. And you certainly don't buy off plan if you think house prices are going to fall. So I think certainly this last year, it's been a boom market for off-plan purchases because everyone's just been like, shit, house prices are going up. I've got to get in, put down my deposit. Whew, I'm safe, right? First home buyers, property investors, everyone's been diving in. It's really interesting when the cycle changes, the mood will change significantly because suddenly buying off plan becomes riskier. So it won't disappear. The reality is off plan's always going to be there. But I think the thing that I sort of say is it's all about the quality of the product and your price point, right? So I think it's just like any housing market. If you build shit product in a softer market, you're in trouble. because the buyers will move to the quality end of the market. Everyone's looking for best value for money. So best quality at fairest price, you're going to be absolutely fine. It's the guys that are selling shit product for too much. They're the ones that will be toast when the market changes.
And there's a question here from Chanel. Typically, what is the percentage of pre-sales from a project finances require from a developer?
It depends on how much you're borrowing. So if we're high, so there's two numbers, right? There's LTC, which is loan to cost. So LTC, loan to cost, how much you need to borrow for the development. The cost equals the land acquisition price plus your project cost, right? So in other words, how much equity do you need to put in? So on an LTC basis, at the moment, we could probably go up to about 80%. Which means 20% equity, but some of the equity can come from valuation uplift, either because you bought well or because of the consenting process. So typically with an 80% LTC, you might not have to put too much deposit in at all. I did one recently where they only had to put in 5%. So the rest of it we got through valuation uplift from resource consent and buying well. But when you're getting up to 80% LTC, you need to have really high pre-sales. So I would say 100%, but you could probably get away with slightly less than that at an 80% LTC. When you get down to sort of 70% LTC, so 30% equity, which is a little bit above where the banks sit, but not much. The difference there between finance companies and banks is that banks will still require you to have really high pre-sales. Certainly enough pre-sales to cover the total project cost. Whereas finance companies at that level will be really flexible. Some of them don't even require a QS. So they won't require a QS. They might not need pre-sales at all, or they might just want to see a small percentage of pre-sales to establish value. But so it's sort of 70% of cost. You've got quite a bit of flexibility, but once you sort of start getting up to 80% of cost and above, all that flexibility disappears.
Cool, that's a great question, and thanks, JB. I do have a question for you. Just going back to the development lending. Earlier, you've indicated that you're seeing that second tier sort of funding is really drying up at the moment. But I also remember you saying that this hasn't really impacted the bank too much. So would you be able to comment in terms of what's the tier one banks doing or not doing in terms of development funding space?
Look, the hard bit is that we normally wouldn't go into the banks for development funding unless it was a bigger project. So I've got a couple of projects underway at the moment that are bank funded, but they're bigger projects. So it makes sense. You're prepared to jump through all of the extra paperwork, because when you go through the bank, there's a lot more paperwork, and they're a lot stricter in terms of just every aspect of it, right? And you'd be surprised how much cost that adds into a project just to comply with the bank's covenants and various aspects of it. With finance companies, it's just a lot easier to deal with, and so whilst you pay a bit more for it in terms of interest rates and fees, you get it back in flexibility and speed. So look, typically the sort of projects that we're doing, we don't do much in the way of big projects. Our biggest projects would be sort of probably around 20 to 30 million of funding, and those projects would put through banks, but the average project that I'm doing at the moment is probably 5 to 10, and that's typically something we put into finance companies. So we haven't really tested the bank on those, and the reason we don't take those into banks is because it's just too hard, and it's just far easier throwing it through a finance company. I think what's going to, and as I said, look, by March, April, it won't matter, because I think the finance companies will have plenty of money again, and this won't be an issue. It's just a temporary short-term issue. Banks are just too hard to deal with in that smaller scale stuff. And look, the reason banks are harder to deal with there is that your property finance units within the bank are full of very smart and very capable lenders. but they don't really like to get out of bed for deals less than sort of 10 to 15 million. So, they don't want to be doing lots of rats and mice deals, because the reality is for them, it's the same amount of work to do a $5 million deal as it is to do a $15 million deal. So, they tend to focus on the bigger stuff, which means that the little guys kind of get neglected in the bank space. And one of the things that banks haven't done particularly well is fill the gap between property finance unit and the rest of the bank, because you can't do development through retail. You would struggle to do it through business banking. You can probably do some of it through commercial, and then there's a bit of a gap up to property finance unit. So when you're doing deals between sort of even a couple of mil, 2 to 10 mil, often it can be quite hard dealing with the bank in that space, whereas finance companies are really easy.
Cool. Knight, did you have any more questions? Or
yeah, I mean, again, thanks, JB. I love listening to your insight, because it is really, really good information. You mentioned that this time around it's different from GFC. Right? There are similarities and there are differences. I recall just going through some stats numbers that previously, I think up to GFC, when our economy isn't doing so well, maybe Aussies is doing better, you will see a huge number of Kiwis going offshore for employment, etc. Do you see that happening maybe next year or two when our economy softens?
I think the problem is you risk being Chicken Little, which is, the world's always coming to an end. The reality is, like I'm in a mortgage business, right? We've got to get up every day and go write mortgages no matter what's happening in the market. And it's the same for builders and developers, right? You don't have the luxury of just going, oh, cool, I'm just going to go take a holiday for 3 years. So you're constantly in market. I think the way I describe markets is, markets never totally freeze. There's always activity going on in markets, but there are times that you're aggressive with your growth strategies, and there's times when you're conservative. This feels like one of those markets where you should be conservative and not going for broke. This is not a market that you should be highly geared in. So I think when I'm talking to guys that we're funding and helping fund, I'm just trying to pull them back a little bit and sort of not get them going too hard too fast. Don't do that extra project. So I did a development a number of years ago myself with a 3 times previously bankrupted developer. As a silent partner, ended up kicking him out of the project. But what was really interesting is his inability to say no. And just keep doubling down and keep going. And I think that's the thing in the construction sector you just got to be careful of, is that it's too easy to drink the Kool-Aid, and it's too easy to believe your own story, and that makes you vulnerable. I think there's enough noise out there at the moment that you should be listening to it, and you should be going, okay, well, look, I've got to keep doing what I'm doing, but maybe I won't do that extra project. I won't take that risk. I won't buy something without finance approved on it already. I've already seen 2 deals this week where guys have bought property and they can't fund it. So, that's crazy in this market. That stuff's got to stop. This is a market where I think it's prudent to be a little bit more conservative, and that's not just a New Zealand thing, that's global, right? I mean, is it Evergrande? I always get the name wrong, but in China, I mean, obviously some major issues going on in China, in the whole construction sector. Not surprised by that. Crypto is another market that is just plain weird, right? I could spend hours talking about crypto. There's so many things going on in the world at the moment that could be considered a black swan event that could tip the global economy into some sort of recession. Now, it's not to say that a recession is going to occur, because a black swan event by its very nature is unpredictable. But there's certainly plenty of risk out there at the moment that would suggest it's a good time to just be a little bit more conservative with your decision making.
There's a question here asking, what's your opinion on international banks, for example, Kuman Bank?
Although I personally don't have literally anything to do with any of the foreign banks in terms of development funding and stuff. Some of my team do. So I know some of my guys use a range of other banks, and certainly the Chinese banks, Bank of China, ICBC, and construction. They're using those, not all that much, but occasionally. So look, those banks are there. Vincent Capital, one of the finance companies, has got a product in the market at the moment with a joint venture with I think Bank of China, which looks pretty attractive. That looks like a pretty good financing deal. That's for a resource consent ready project, ready to build in Auckland. So it's got some limitations on it. It's certainly not going to help with pre-development land acquisition. But if you've got a project ready to go, that financing looks pretty attractive. So I think there's a whole range of options out there. I think the main thing is and look, in all honesty, it surprises me the number of guys that try and do it on their own. I think get some good advice, have a good team around you, including the finance side of things. Know what your options are. Look, I think everyone only ever comes for advice when something goes wrong. Which is kind of crazy. Good advice is actually to stop things going wrong. So, yeah. The only other thing I'd say is stop, for some of the guys probably on this call, stop using brokers that don't know what they're doing. It staggers me how many people use brokers for finance when their broker doesn't know how to fund development stuff. It seems crazy, like, if I was paying a real estate agent to sell my property, I'd go and find the best real estate agent. I wouldn't just go grab any old real estate agent because it's going to cost you the same no matter what, right? I'd go and get the best one. It staggers me how many people pay professionals and don't bother going out and getting the best professional. And that, look, in any walk of life, whether that's, lawyers, brokers, real estate agents, the whole gambit. Anyway, that's enough for me.
There is one more question on the chat. Does the topology floor plan, i.e. 3-bed, 2-bed versus 2-bed, have a significant impact when taking a deal to a potential lender?
Not really. Not from a development funding perspective. But what I would say is that 3-beddies are way easier to sell. You've got to get the price point right. So one of the things that I think I would be careful in this market is getting your price point right. Especially for entry level housing. I think that's going to be particularly important next year. I know, like in the last year or so, house prices have been creeping up, something chronic, and in the Auckland market, which I know a bit better, we've seen sort of 2-beddy townhouses, sort of hitting over 800,000, and 3-beddies going to $1 million, and in suburbs where you could probably buy a house for $1 million. Or you used to be able to buy a house for $1 million. So, look, the market's moved quite a bit in the last year, and I think that's where the danger is in assuming that those prices can hold. I think the first home buyer affordability's come back a bit. So, I'd be really focused on your price points. Now, in the short term, that's probably not an issue. So, for the next 3 to 6 months, maybe it's not an issue. You should be able to clear out any stock. I think the market will be okay, but it's something to be really mindful of is that, when I'm doing a feasibility, I'd be doing my feasibility with lower sale prices and making sure that I'm happy with it. And then if I get extra, it's a bonus. But I'd definitely be running softer house prices in my feasibility now. 3-beddies are far easier to sell than 2-beddies, but you've got to be conscious of the price point because, there's not an unlimited number of buyers out there. And, first home buyers have been incredibly strong in market for the last year or so. But my caution is that I'm just expecting to see the edge come off that market. Now, the other thing to think about is where. So high income first home buyers aren't really that impacted by this. So if you're building into suburbs where your target customer is, high double income, maybe one kid or no kids, then you're probably fine, right? That market, there's probably still a lack of product into that market. You can certainly justify a higher price point. Depending on who you're targeting, I certainly think 3-beddies sell a lot better. A lot of these guys are doing terraced housing are doing a mixture of the two. So normally a couple of 3-beddies and a bunch of 2-beddies, which is fine. The 3-beddies seem to go out the door first. But there will be some parts of this market where the price points are just too high. I'm really concerned about South Auckland. From an Auckland perspective, that's where I sort of see. I think some of the developers have been paying too much for land down there, and I think they're reliant on house prices. I just don't see holding up. So I think some of the riskier areas will be down in Manurewa, Otara, sort of down there where I'm seeing people buying land for 1.3, 1.4 million. And, I haven't looked at their feasibilities, but, I'm imagining that, this is going to have feasibilities that have them selling these terraced townhouses at, sort of 800 to 900,000. And I think that's where you're going to run into the CCCFA issues. That's where you're going to run into a lot more buyers that just aren't going to have the affordability there. So, that's where I think, just be on to that and be aware of it. Yeah. That's also where I think you're going to see the settlement risk as well.
That's really good advice. Knight, do you have any last questions? Otherwise, we'll wrap up.
No, I don't. I just want to say, thanks very much, JB. I've learned a lot myself. I mean, we sort of here at Relab, we have a lot of our users, our customers, for our agents, developers, first-time buyers, etc. But I think this session really encapsulated all of their burning questions. So thank you very much. One big takeaway that I had from your earlier comment was consult a professional. Don't try to do everything yourself. So there's obviously a finance professional that can consult, and the Squirrel in your team is definitely one of the top guys out there. So my advice for everyone listening is, before you sort of commit and get into a big project, do take your time and get in touch with professionals to help you.
Yeah, no, thanks, Knight. Look, I think, in closing, look, I don't think I'm overly conservative, but I'm just one view of the market, right? And I certainly don't get it. I always don't get it right. I didn't think interest rates would go as low as they did. I thought house prices would soften before they did. I certainly didn't. I did forecast that the average house price in New Zealand would hit $1 million, but I said by 2030. Happened a little bit faster than that. So like any of these things, it's an opinion, right? And you should seek multiple opinions and everything else, and you should make up your own mind. But if there was one thing for me, it's like you just got to get on with your life. You got to keep doing what you're doing. It does feel like it's an environment that's inherently more risky, and so my biggest piece of advice would be just to be a little bit more cautious and cover your risks a little bit more than you otherwise would, and make sure you've got a backup strategy. Go on with a plan A, B, C, D.
Question, actually, can I squeeze one more in?
Yeah.
I really don't like the idea of the banks making judgments, because of this change, but it's kind of already done deal. So, question for you, JB: avocado on toast, smashed up, yes or no?
Sorry, what's that?
Smashed avos on toast, yes or no?
I love smashed avo on toast. And the good news, Knight, is that smashed avo is really cheap at the moment because we've got an oversupply of avocados, right? So it's actually not a luxury good anymore. Avocados are probably one of the cheapest fruits around, right? Is an avocado a fruit or a vegetable?
That's next.
Who knows?
I don't know. It's getting too technical. Awesome, mate. I better go.
Thank you so much for coming on, and thanks for everyone for joining us.
Hopefully it was useful.
Yeah, totally.
Thanks, everyone.
Cool.
Cheers,
Okay.
JB.
Cheers, mate.